This strategy is a no-brainer. Whether you are a beginner trader or an advanced trader, you can actually upgrade your trading experience using the strategy I'm about to show to you now. The strategy uses the daily time frame candlestick and the 1H time frame and the 5M time frame. I'm going to show you how you are going to combine these three time frames together to have a high probability setup in the market. Now, if you have been taking losses in the market, when you finish watching this video and back testing on it several times to master it, then you will thank me for giving you this video for free. Now, how does the strategy work? The first thing you need is to identify the bias of the market using the daily time frame. I've spoken to us severally about how to determine the daily bias with two candlesticks, meaning that if you have two same colored candlesticks printed on each day, then you can actually determine the bias of the market. There's another way to determine the bias of the market, which I've also done a video on, meaning if you have two opposite colored candles, you can also determine what you are expected the following day. Okay? But in this case, we are going to be using same colored candles, two of them, meaning that you are waiting for 2 days of trading data for you to be able to trade this strategy successfully. Let me start by showing that to you. Look at this first diagram. As you can see, this is two bullish candles, and this is a 2-day trading data that the market has given to us. Now, once you find these same colored candles like this, something should switch in your mind that the market's bias is bullish. And therefore, what you want to do on your daily time frame is to mark out the high of that second day's candle, just like so, and the low of that daily candle, you mark it out. Once you have done that, you want to go to the 1H time frame. I'm slow because I want you to grasp every bit of what. Now, you want to wait for price to rotate back down within this range. You really need that to happen within the range to go and tap into an area of interest. Now, your area of interest could be your order block or order flow. Now, but you want to wait for the extreme of that area of interest. Okay? You don't want to take trade in the middle of nowhere. You want to take your trade at the extreme within this box. It has to be within the box. Okay? Once you take that trade, then you can target this high. Simple. Very simple. So that is one way you are going to take the trade. The second method is this. If price does not rotate back down, in the case of a bearish scenario like this, price doesn't rotate back down to go mitigate out of extreme area of interest, and rather price goes ahead when price opens, it goes ahead to break the high. Okay? And once it breaks the high, mark out your fair value gap. Okay? The first fair value gap after breaking the high. Once you mark it out and you want to wait for price to return into that fair value gap to take you higher, simple. It's a no-brainer. Just the same thing with the bearish scenario. the bearish scenario, 2 candles like this. Once you find this, then you know that the bias of the market is bearish. Now, again, is it going to be 100% or bulletproof? No. There is nothing that is set in stone when it comes to the financial market. So I want you to understand that. So what you want to do is to mark out these candles high and then mark out the candles low. Once that is done, you want to go to your lower time frame, which is the 1H in this case. Remember, I told you we are using 3 time frames, and I'm going to tell you the reason why we are using the 3 time frames. The time frames we are using, once again, are number 1, the daily time frame, the 1H time frame, and of course the 5M time frame. The reason why we are using the 5M time frame is so that if on the 1H time frame the area of interest you have marked is too large and will not give you a good or better risk to reward, then you can refine that zone if you like on the 5M time frame. That's simply the reason why we are adding the 5M time frame to what we're talking about. Okay? So, bearish scenario, mark out the high and low of the second day's candle. Now switch to your 1H and wait to see price coming to tap into a zone on the 1H time frame, and there you can take price lower. Simple. That's the first method. Now the second method is if it doesn't rotate back up within this zone, this high and low of this candle, if it doesn't rotate back up to go and mitigate out of any valid area of interest. Okay, remember your area of interest could be the order flow, it could be the order block. It depends on your entry trigger. Now, if it doesn't do that and price goes ahead from this low to break, all right, to break this low, now you need to wait and mark out your fair value gap. And as you mark out the fair value gap, you want to wait for price to return into that fair value gap and boom, going down. It's as simple as that. That's why I say it's a no-brainer. So that being said, let me take you to the live chart and then show you some examples of what I'm talking about. And the first thing you need is to identify the bias of the markets using the 2 colored candles, the same color candles that I told you about earlier on. Now, if you look at this, let me take price out from here so it can be easier for us to understand. I want to start with this now. Now, if you look at this, this is a bullish day, and this next day is also a bullish day. This one was also a bullish day. Okay, so this should tell you that we want to go higher. More so, apart from these 2 colored candles, look at how price took out the low of this previous candle and closed above the high of that sweeping candle. Can you see that? And then you have these 2 same colored candles. This is a clear signal to you that the market is about to go higher. And if you can see, we have been going higher, 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 higher. Count the number of the bullish candles here and then count the number of the bearish candle. You realize that the number of bullish candles outweigh completely the number of the bearish candles. So we are pretty much bullish. So that's what you want to determine first. Now, after determining that, I said, mark out the high and low of this candle number 2 that you want to trade. Mark out the high just like so, and then the low just like so. Okay, that's all you need on the daily time frame. Having done that, switch over to the 1H. Now, this is what we have marked on the daily time frame. Within this zone here, okay, you want to wait for price to come and take out, for price to come and mitigate out of an area of interest. Either an area of interest, or if it breaks this high, then you need to wait for fair value gap and then enter your trade from there. Simple. So in this case, where is your area of interest? Well, you can say this is your area of interest. But look at this area of interest, guys. I want you to look at this area of interest. What do you notice? Check. What do you notice in this area of interest? Now, this is in the middle of nowhere, so you don't want to take your trade from here, because I said to you, take it from the extreme area of interest. Now, if you look at this point, maybe we can look at this as a valid OB, but my valid OB must take liquidity and must have fair value gap. Is there any liquidity that it has taken? Yes, of course. Look at this low. This is a structured low. Did he take it out? Yes, it took it out slightly. Can you see that? So that's a valid OB. And therefore, this, our area of interest, is no more valid there. So if price comes back down, we want to take trade from this zone, this very zone. That's where we want to take trade. But if price doesn't come down, and then price does something like this from here, goes up to take out this high, now you need to mark out your fair value gap and wait for price to return to it before you take your trade higher. Okay, so simple. So let's continue to advance price. Okay, so can you see that? We now have, the price didn't come down within this zone to come and tap into this. So this is no more valid here. We take it out. Now that it has broken and closed, it has to close above. I forgot to tell you that. It has to close above. Now that it has closed above, where is your zone here? Now, this is your zone. This is your fair value gap from this high. From this candle's high to this candle's low. It's your fair value gap. Simple. So you want to take your trade from there directly to go higher. And where are you going to target? Well, in this case, do you have anything here, any structure that you want to target here? Okay, so maybe we target this one first of all. This is the one we will target first of all. Okay, after then, we target this. Is that going to be our second target? So we can actually play price now to see what happens. That's our second target. So let's continue to advance price and see how price will play out here. Okay, so we have been tapped into the market right now. Your stop loss just below. So that's our first TP. Okay, then once the first TP is achieved, then target this second TP. That's our trade. So let's continue to advance price. Boom. Can you see that? Smashed easily. Easily. That's the first example. Now, this is the second day. Let's mark out the high and low. Okay, so that's the high and low of the daily time frame. Then we go to the 1H. So this is the zone on the 1H. So if price opens and then comes back down to tap into this area of interest, look at this one, clear, clean, clear. So this is our area of interest. But if you look at this area of interest, it's pretty too large. Pretty too large. Like I said to you, you want to position yourself to have a high reward to risk. Okay, now there are two ways you can refine this zone because it's too large. Remember, this is 1H. So two ways to refine this zone is either you use your flip tool and mark the 50% of this entire zone, and this will be your 50%. So you can actually do the 50% like this. You are waiting for price to come and tap into this 50%, okay, before you take your trade. That's one way. Second way is that you can go to the lower time frame, like the 5M, like I told you, and see whether there's going to be any refinement. But I think we have refined very well on the 1H time frame. But let's see whether we can find a better refinement here to maximize our reward. But remember, the more refinement you do, the possibility of missing the trade is there. Look at this. This is a zone. This one is a zone, but if you mark this order flow, it's already mitigated. No, it's not. This order flow is not mitigated. Okay? Now, don't think that this is mitigation. This is not a proper mitigation. All right? So this order flow is still very much intact. This order flow is very much intact. So we want to use this, and let's see. Remember, this is 1H refinement and this is the 5M refinement. So we want to take this 5M refinement. So let's continue to advance price. Remember, price is still within our daily candle high and low. So let's get to the 1H so that it can be faster. This is the 5M refinement, and this is the 1H refinement. So we are still within the zone. Okay? If it breaks out of this zone, then this entry method will change to the fair value gap type that I told you about. So let's continue. So it has tapped into the 5M, so we can do away with this. Our 5M refinement has been tapped into, and therefore we can take our trade from there. I want to believe it can. Let's take our trade from there. Our TP at this zone, and then stop loss just below, give a buffer. So that's our trade. Let's see whether it will go our direction. Boom. Can you see that? Now, after taking out this high, go back. Just be satisfied with what you have gotten here. Don't be greedy. Take the money from off the table. Now, go back to the daily time frame. This is 1D time frame again. So we are going back to the drawing board now that we have achieved this. Okay, so let's clear everything here and have a clean chart. So the next day, we want to also mark out the high and low. This is our low and our high right there. Simple. On the daily time frame. Now let's get to the 1H time frame. Now look at the 1H time frame. Do you have any valid area of interest within this box? No, we don't have. Meaning that it's likely that when price opens, price is likely to do something like this, to go and break this high. And once that happens, mark out your fair value gap and wait for it to come into it, and boom, you want to take price higher. So let's continue to advance price. Can you see that? Now, here is your fair value gap. The fair value gap can be too large, but if it's okay for you, you can take the trade. Why not? Or you want to use the 50%. Remember, the more refinement you do, the possibility of missing the trade is there. So this is the 50%. That's the 50%. So we can do away with this. So let's continue to advance price. So price tapped into that precisely, into the 50%. And so we can take the trade higher from here. And our TP will be where? In this case, you want to do 1 to 2. Well, 1 to 2 would have been smashed, but then you can start trailing your stops. Can you see that? It hits the stop loss easily. And look at the massive profit you would have made here. Very simple strategy, straightforward. You don't need to stress yourself, guys. If you are enjoying the video, please remember to strike the subscribe button and become part of the family, and then turn the notification so you don't miss any of our videos again. So this is the way for you to use the daily time frame, the 1H, coupled with the 5M, and take high probability trade scenarios. If you cannot upgrade your trading with this strategy, guys, I'm sorry, I cannot help you anymore. Alright guys, but before you sign off, please, if you haven't joined our free Telegram channel, just do so just immediately. And if you want to join our VIP community, the doors are open. That's how far we can go today. I see you in our next class.